Hey guys, this is Peter and welcome to Money and Investing. Return on equity, or ROE, is a measure of financial performance calculated by dividing net income by shareholders' equity. Because shareholders' equity is equal to the company's assets minus its debt, ROE is considered the return on net assets. ROE is considered a measure of how effectively management is using a company's assets to create profits. By the way, if you like these kind of videos, it'd be awesome if you'd hit the early like button and subscribe. It really helps out the new channel and gives me inspiration to create more content like this. Thanks a bunch. Here are a few key takeaways. Return on equity, or ROE, measures how effectively management is using a company's assets to create profits. A higher ROE suggests that a company's management team is more efficient when it comes to utilizing investment financing to grow their business and is more likely to provide better returns to investors. A low ROE, however, indicates that a company may be mismanaged and could be reinvesting earnings into unproductive assets. Whether ROE is considered satisfactory will depend on what is normal for the industry or company peers. As a shortcut, investors can consider a ROE near the long-term average of the S&P 500, about 14%, as an acceptable ratio, and anything less than 10% as poor. ROE is more than a measure of profit. It's also a measure of efficiency. A rising ROE suggests that a company is increasing its profit generation without needing as much capital. It also indicates how well a company's management deploys shareholder capital. A high ROE could indicate a good utilization of equity capital, but could also mean that a company has taken on a lot of debt. Excessive debt and minimal equity capital, also known as high debt-to-equity ratio, may make ROE look artificially higher compared to competitors with lower debt. ROE is expressed as a percentage and can be calculated for any company if net income and equity are both positive numbers. Net income is calculated before dividends paid to common shareholders and after dividends to preferred shareholders and interest to lenders. The formula is as follows. Return on equity equals net income divided by average shareholders' equity. Net income is the amount of income, net of expenses, and taxes that a company generates for a given period. Average shareholders' equity is calculated by adding equity at the beginning and end of the period. So what does ROE actually tell you? Whether ROE is deemed good or bad will depend on what is normal among stock peers. For example, utilities have many assets and debt on the balance sheet, compared to a relatively small amount of net income. A normal ROE in the utility sector could be less than 10%. A technology firm may have a normal ROE around the levels of 18% or more. A good rule of thumb is to target a ROE that is equal to or just above the average for the peer group. For example, assume a company has maintained a steady ROE of 18% over the last few years, compared to the average of its peers, which was 15%. An investor could conclude that TechCo's management is above the average at using the company's assets to create profits. Relatively high or low ROE ratios will vary significantly from one industry group or sector to another. When used to evaluate one company to another similar company, the comparison will be more meaningful. We can also use ROE to estimate growth rates for a company. Sustainable growth rates and dividend growth rates can be estimated using ROE, assuming that the ratio is roughly in line or just above its peer group average. Although there may be some challenges, ROE can be a good starting place for developing further estimates of a stock's growth rate and the growth rate of its dividends. These two calculations are functions of each other and can be used to make an easier comparison between similar companies. To estimate a company's future growth rate, multiply the ROE by the company's retention ratio. The retention ratio is the percentage of net income that is retained or reinvested by the company to fund future growth. Using ROE to identify problems. It is reasonable to wonder why an average or slightly above average ROE is good rather than a ROE that is double, triple, or even higher than the average of their peer group. Aren't stocks with a very high ROE a better value? Sometimes an extremely high ROE is a good thing if net income is extremely large compared to equity, because a company's performance is so strong. However, an extremely high ROE is often due to a small equity account compared to net income, which indicates risk. Share buybacks. In some cases, a company may reduce its equity by repurchasing its own shares or using excessive amounts of debt to operate the business. When equity is reduced, ROE rises, even if the company is mismanaged. Inconsistent profits. The first potential issue with a high ROE could be inconsistent profits. Imagine a company, Losco, that has been unprofitable for several years. Each year's losses are recorded on the balance sheet in the equity portion as a retained loss. the losses are a negative value and reduce shareholders' equity. Assume that Losco has had a windfall in the most recent year and has returned to profitability. The denominator in the ROE calculation is now very small after many years of losses, which makes ROE misleadingly high. Excess debt. A second issue that could cause a high ROE is excess debt. If a company has been borrowing aggressively, it can increase ROE because its equity is equal to assets minus debts. The more debt a company has, the lower equity can fall. A common scenario is when a company borrows large amounts of debt to buy back its own stock. This can inflate earnings per share, but it does not affect actual performance or growth rates. If shareholders' equity is negative, the most common issue is excessive debt or inconsistent profitability. However, there are a few exceptions to that rule for companies that are profitable and have been using cash flow to buy back their own shares. For many companies, this is an alternative to paying dividends, and it can eventually reduce equity. Buybacks are subtracted from equity, enough to turn the calculation negative. In all cases, negative or extremely high levels of ROE should be considered a warning sign worth investigating. In rare cases, a negative ROE ratio could be due to a cash flow supportive share buyback program and excellent management, but this is the less likely outcome. In any case, a company with a negative ROE cannot be evaluated against other stocks with positive ROE ratios. So let's take an example of how to use ROE. We can consider Apple. The company generated $59.5 billion in net income. At the end of the fiscal year, its shareholders' equity was $107.1 billion versus $134 billion at the beginning. So to calculate ROE, we need the net income divided by average shareholders' equity. To get average shareholders' equity, we just add beginning shareholders' equity by ending shareholders' equity and divide that by 2. And to get ROE, we just divide net income, which is $59.5 billion, divided by average shareholders' equity. And this comes out to 0.494. So this means for every $1 of equity, the company generates 49 cents in profit. So when we compare Apple to its peers, we see that Apple's ROE is much higher and could be a better investment. This is Money and Investing. Thanks guys for checking out my video. Let me know your comments and what you think below. If you liked the video, hit the like button and subscribe. See you next time.